This is episode 232 of Zen and the Art of Real Estate Investing with my guest, Paul Shannon. Paul is a fund manager at InvestWise Collective. He's acquired well more than 200 residential units by recycling equity and JV. He's a limited partner, invested in well more than 40 deals as a passive investor. And all of this led to him becoming the co-host of PassivePockets, BiggerPockets' new podcast on passive investing. Paul, welcome to the show.
Jonathan Green, thanks for having me. Excited to be here.
Yeah, I'm excited to talk to you, and it's been nice to see you guys get rolling with PassivePockets. But it's interesting to think about because when I think of PassivePockets and just, syndication investing, when I was growing up, I didn't hear anything about it. My dad was an investor. I didn't know anything about it. When was the first time that you remember hearing about syndications? And then we'll get to your whole background in real estate, because I know it came after you started with other assets.
The first time I heard about syndications was probably, around 2013, I would say. The Tax Cut and Jobs Act had passed. 2012, big changes were made, obviously. And then I think later on, during Trump's first administration, they made some changes to it again that made it more advantageous for private equity and private placement deals within real estate and syndications. So I had heard a little bit about it. I always kind of wondered what was happening on Main Street. How are these big apartment deals getting done? They spend that much money, with these wealthy families. Turns out there are some that have the money to do these deals on their own. But in many cases, it's a group of investors coming together. There's somebody who's got the experience, the track record, and the know-how to get the job done. That's the general partner. And they just happen to be connected to a lot of other folks that are interested in real estate, but don't necessarily want to do the day-to-day job or don't have the time. So I thought that was really cool and unique. And it sort of shifted my train of thought and started to think a lot bigger. Originally, I was interested in real estate for passive income. I learned from an active experience investing in single family homes that it's far from passive. But I still enjoyed it and I still do it today. But it really kind of scaled my thought process as to what's possible.
Yeah, I think that's a recurring theme with a lot of people who eventually get to syndications. Like, okay, doing flips and doing burrs and doing small scale apartments, it all makes sense, but you can't scale just on those assets. It's like having 100 single families versus having a 100 unit apartment complex. It's just, one's much easier to manage than the other for obvious reasons. What did you start with though? What was your first entry into real estate?
I actually started, I bought a duplex that was built at the turn of the last century. So 1900s or so. It came with tenants in it. It had, old house problems more or less. And got my, my stripes earned the hard way by learning how to deal with maintenance issues, building relationships or lack thereof with contractors, understanding how leases are structured, working with tenants to be fair on issues that came up in their lives, and getting some empathy behind being a landlord versus being a resident. I held that property for a couple of years, didn't do great on it, but I didn't lose money either. Learned a lot from it. I bought a couple single family homes, and that's where I really cut my teeth on renovation and rehabs, doing burr type investing and a few flips. And I probably had, I think, 6 or 7 properties under my belt prior to me going full time into investing in 2019. And that's what things really scared up.
So it's going to be interesting to talk to you about how you got out of that and just let somebody else take the reins, because it was harder for me. But when I chose the right operators, I was like, wow, this is really, the future for me and for my kids, because then they don't have to manage it. It's, they don't have to go inherit an 8-unit apartment complex with a bunch of crappy tenants. That's for somebody else to handle.
Yes. Yeah, exactly. I've always looked at it like, if I can be an expert in my local market, which to me requires you to have relationships with everybody in the real estate business that's local to you. That means property managers, other investors. It means contractors, off-market deal flow, lenders, right? So brokers. So all these people are connected in your community. And if you're really tied in, you have an unfair advantage potentially in that market. If you try to pick up and go somewhere else as an active operator, general partner, I always scratch my head when people do it and I see it happen. And I'm thinking, well, if they're the new guys in town, it seems as if everybody that does have the unfair advantage might have already looked over all these deals that they're now getting access to off market. Yeah. And they're getting these great assets. You wonder what they don't know. Right. So for me as an active investor, I always appreciated staying with what I know and being within my niche. And that's a pretty small niche, right? Indianapolis, Evansville markets are where I play, and it's multifamily, residential, single family still a little bit here and there. So it's it's very specific, and this is a cyclical business. So if
Yeah.
things aren't humming along and going well for me, I still want to deploy capital, and I still want to do it efficiently, and I want to diversify. So I always looked at being a limited partner as a way to achieve that. I can tap into the expertise of other people that are doing similar things that I'm doing in my market, but they're doing them in places like the Sun Belt or Texas or in the Mountain West. These are geographies that I don't have access to from an expertise standpoint. They're doing it in different asset classes like self-storage, mobile home parks, private equity businesses, debt funds, you name it. There's so many things that you can syndicate these days that I kind of get excited like a kid in a candy store.
Yeah.
And I want that. I want that diversification. There's a place for that in my portfolio. And then lastly, I thought, well, hey, I don't mind diversifying away from myself. I mentioned I got some tailwinds before. I'm happy to share that I feel very blessed and lucky to get some of the deals done that I have along with the hard work. But what if things don't go that way forever?
Yeah.
I like to diversify away from myself and get with other operators that have, maybe a better advantage than I have in their market, or, they're going to expose some opportunity that I can't locally. So all those things make me excited about investing both actively, where the returns are generally higher, and passively, where I don't have to do anything and the money just shows up. Is
Yeah.
it safe with the U.S. government today owing so much money? But the general point is that there's value in all asset classes. It just matters on what your risk tolerance is as an investor, where you are in your life, right? If you're 20, your goals are going to be different than your
Yeah.
60,
Yeah.
and just kind of being diversified across a lot of different opportunities and assets, and being protecting the downside.
Yeah, and I think assessing your own personal risk tolerance is important. We were saying before that we thought, a lot of people jumped into syndications and just trusted everybody because everything looks good. Every PDF that I look at looks like it's going to crush it, but if you really know what you're looking for, you can get through it quickly. But, I've had to identify, I have a high risk tolerance. It doesn't mean I'm risky. It just means I understand the risks and I'm willing to take it. Do you think that's a really important something that investors need to know at some point? Because I think the people who get themselves in trouble is they don't adequately understand their risk tolerance. So they're taking much bigger risks than they even know that they're taking and that they would have wanted to. And probably their family spouse doesn't want them to take those risks.
Yeah, I mean, 100%. I think that's one of the biggest problems is that, LPs that are really upset with these sponsors that they lost their money. A lot of the sponsors can turn around and say, well, it's all here in the documents.
Exactly.
You could have looked at it. You could have saw exactly what you were in for if things went the way they went. So, I think that aligning risk is critical within yourself as an investor. And unfortunately, sometimes the hardest way, or the easiest way, I should say, to learn is through pain. Hardest and easiest. Like that's the only way to learn is by getting burned and understanding, man, that didn't feel too good. I don't like that. I don't want to do that again. So now learning from that lesson, you can kind of reevaluate your risk tolerance and get into something that aligns more, more with it. So there were times it was so frustrating for me to look at deals in 2022 and not just put my foot on the gas, because I realized there was so much opportunity for me as an entrepreneur.
Have you seen that there's a lot more interest in syndications from newer people than you thought? Because that's what I'm seeing now. Maybe because I'm just telling newer people now as well. I'm like, listen, if you have capital, don't do a flip. You don't know what you're doing. Your risk is way higher on that than investing with someone passively. Again, just let your money do the work. Are you seeing that as well?
Yeah, I am. I mean, it's extremely difficult if you're a new investor and you were on the BiggerPockets side and you're interested in single family flips or burr investing. I mean, it's a very difficult time to be in the space. We were extremely active through 2022. Actually, we had some unique banking relationships and some in 23 as well. But for now, with rates where they are, I think you alluded to it at the beginning of the show. It's like, it's really difficult to make things pencil and make it work. So, I would say, good advice, right? There's potentially better yield for less work on the passive side right now. We are seeing that there are people that are coming over from that, that kind of mantra and that space and getting more exposed to syndications and understanding where, investors from the last few years have been and kind of learning from that, not necessarily through their own experience, but just a cautionary tale, right? And I think that that's what that last crop of investors maybe that got into it when I did, didn't necessarily ever experience. You don't know what you don't know until you experience a downturn. So hopefully this new batch of investors that's coming in now and getting exposed to passive real estate investing learns from those mistakes through osmosis and can kind of be better prepared for the future and structure their portfolios more prudently. But I think the space is really in its infancy, and the issues that have been faced over the last couple of years are good for it. It doesn't look like it right now, but potentially some more regulation might be warranted. More education. Just understanding again what you're investing in is so critical. So anything that can be done to get people more up to speed on the merits of the asset classes, but also the risks, are going to be very good steps to take.